What's up, you guys, and welcome back. If you're new here, my name is Cory. On this channel, we talk about personal finance and investing, and today I wanted to talk about some tax-advantaged accounts. Now, when it comes to investing, there's a number of tax-advantaged accounts that you should know about. Now, let me set this up for a minute. Why would we invest in a tax-advantaged account at all? Some of these accounts you have to wait till you're 59 and a half before you can access them. Stick with me and I'm going to show you why we want to invest in tax-advantaged accounts whenever possible and whatever ones are available to you. It would mean the world to me if you click that like button for the YouTube algorithm. Now let's jump into the video. A lot of investors already know that minimizing fees and choosing low-cost index funds and not handing your money over to your buddy's broker are some of the best ways to lower your fees and increase returns. But do you know what the single largest bite that's going to be taken out of your overall returns is? Survey says taxes. Taxes. We have to talk about taxes. The suggested IRS motto should be, we have what it takes to take what you have. Now, it's not necessarily what you earn that matters, although that's the biggest lever to pull when creating wealth. It's what you keep that matters. Remember, those hidden fees on mutual funds can average an insane 3%. That can eat up a potential 50 to 70% of your future nest egg, because that money could be compounding for you. But taxes are just as important, if not more important. Now, let me set this up a little further for us. The average American over the course of our lives pays over half of our income to an assortment of taxes. Let's see, income tax, property tax, sales tax, tax at the pump, and so on. That's about 54.25%, some experts estimate. Good old Uncle Sam. After 54.25% is taken right off the top, you can kiss goodbye another 17.25%, depending on the household, for interest on your car and your home mortgage. The average household credit card debt in March of 2021 is an average of $7,000. Student loan debt is $58,000, and mortgage debt of $197,000 on average.
We are up to our eyeballs in debt.
It's your fault! It's your fault! You work your butt off your whole life!
Debt.
And you have nothing to show for it! Nothing!
But let's stay focused. Tax efficiency is one of the easiest ways to increase performance and overall returns in your portfolio value. And I want to talk about those accounts right now. Now, how do we legally take advantage of decreasing our tax bill while simultaneously increasing our returns so we can achieve our goals faster? We do this by investing in a way that allows you to defer your taxes only to a time when you sell your investments. If you do invest or have already invested in a non-tax advantaged brokerage account, make sure you hold your investments for at least 1 year and a day to take advantage of the long-term capital gains tax rate. At the time of this recording, long-term capital gains tax is a tax on profits from the sale of an asset held for more than a year. The long-term capital gains tax rate is 0%, 15%, or 20%, depending on your taxable income and filing status. They are generally lower than short-term capital gains tax rates. Long-term capital gains tax rates are broken down by income. Single filers' long-term capital gains tax rate $0 to $40,000 a year is 0%. Long-term capital gains tax rate $40,000 to $441,000 is 15%. All right, now that we've gotten all that out of the way, let's dive into the actual tax-advantaged accounts that might be available for you to invest in. Now, before we even dive into these accounts, I want to make one thing super clear. Investing in a 401k, 403b, IRA, Roth IRA, or HSA are not investments in and of themselves. They are just the accounts or the vehicle that you hold your investments in. Does that make sense? Now let's take a deep dive into each one of these accounts. Number one is a Roth IRA. Now, a Roth IRA is considered a self-directed account, meaning this is not through your employer. You can withdraw your contributions to a Roth account at any time for any reason, tax and penalty free. You must be at least age 59 and a half to withdraw your earnings tax and penalty free, and you must have owned your Roth for at least 5 years. The 5-year holding period starts in January 1 of the year you opened your account. The actual amount that you're allowed to contribute to a Roth IRA is based on your income. To be eligible to contribute the maximum for 2021, your modified adjusted gross income must be less than $125,000 per year if single and $198,000 per year if married, filing jointly. You can't put any money into a Roth IRA once your income reaches $140,000 if single and $208,000 if married and filing jointly. The maximum contributions for 2021 in a Roth IRA is $6,000. However, if you're age 50 and over, it's $7,000. Number 2, IRAs. The maximum amount you can contribute to an IRA in 2021 is $6,000 if you're younger than age 50. If you're 50 and older, your maximum IRA contribution is $7,000. Your IRA contribution may also be tax deductible if you or your spouse doesn't have a retirement plan at work, such as a 401k or 403b. You can deduct a full contribution to your traditional IRA on your tax return, no matter how much you earn. If you're single with a modified adjusted gross income of $66,000 per year or less, or married filing jointly of up to $105,000 per year, you can deduct the full contribution for the 2021 tax year. Deductions thereafter decrease and phase out completely once income reaches $76,000 for singles and $125,000 for joint filers. Now, eventually you will have to pay taxes on your traditional IRA. Your withdrawals will be subject to ordinary income tax. On top of that, if you take the money out before turning age 59 and a half, you can be hit with a 10% penalty. You will also be obligated to take required minimum distributions, or RMDs, after you turn age 72. Now, additionally, if you invest in both a traditional IRA and a Roth IRA, the total amount of money you can contribute to both accounts can't exceed the annual limit of $6,000 or $7,000 if you're 50 or older. If you do exceed it, the IRS might hit you with a 6% excessive contribution penalty. You don't want that penalty. Number 3. 401ks. A traditional 401k is considered an employer-based retirement plan that you fund through payroll deductions before taxes have been taken out. Those contributions lower your taxable income and can help cut your tax bill. For example, if you make $50,000 a year and you contribute $10,000 to your 401k, you're only taxed on $40,000. Money in your 401k account is tax sheltered as it grows. The maximum amount you can contribute to a 401k for 2021 is $19,500 for those younger than age 50. If you're age 50 and older, you can contribute $26,000 per year. You have to be 59 and a half to withdraw your money from a 401k without incurring a 10% penalty. Again, you don't want that penalty. Number 4. A 403b. Your 403b is also considered, like a 401k, an employer-based retirement account you fund through payroll deductions before taxes have been taken out. Those contributions lower your taxable income and help cut your tax bill. For example, again, if you make $50,000 a year and you contribute $10,000 to your 403b, you're only taxed on $40,000. Additionally, like a 401k, the money in your 403b account is tax sheltered as it grows. The maximum amount you can contribute to a 403b retirement plan for 2021 is $19,500. If you're 50 or older, you can contribute a catch-up contribution, bringing your contribution total to $26,000. Again, you have to be 59 and a half to withdraw the money from your 403b without incurring a 10% penalty. Now, number 5 is an HSA. A lot of people don't know about these HSAs, and as such, they're leaving a lot of tax savings on the table. An HSA is considered a triple tax advantaged account, and I'm gonna show you why. Now, point number 1, contributions to an HSA are considered pre-tax and reduce your taxable income. Number 2, your HSA funds can be invested to grow tax-free in index funds, i.e. your total stock market fund or other indexes. Number 3, when used to pay for eligible medical expenses, HSA withdrawals are tax-free. You can contribute up to $36,000. In 2021, if you have self-only coverage, or up to $7,200 for family coverage. To contribute to an HSA, you must have a high deductible health insurance plan for 2021. The health plan must have a deductible of at least $1,400 for self-only coverage or $2,800 for family coverage. Now, the simplest way to figure out if you have a high deductible insurance plan is just to call your provider. I know. If I had a choice to be locked in a padded room and listen to the most annoying sound in the world for the rest of my life, or call my insurance company, I would for sure be locked in a padded room listening to the most annoying sound in the world for the rest of my life. Just do it. You will thank me later. At age 65, those HSA funds can be used to pay for general living expenses, housing, food, or travel. This means withdrawals can be taxed like any normal distribution from a retirement account. Unlike a 401k or IRA, HSA contributions made via payroll deductions aren't subject to Social Security and Medicare taxes, and a person is not required to take minimum distributions at any age. In addition, HSAs are also not use it or lose it accounts, and your balance carries over each year. When enrolled in an HSA, you can choose to cover medical expenses out of pocket now and take a tax-free distribution in the future in the amount of your current expenses. This approach allows you to use your HSA as a potential emergency savings vehicle. Just make sure you hold on to your receipts to verify all distributions. Well, I hope this helped answer some questions for you. This was a deep dive into some tax-advantaged accounts that I think you're eligible for, or you can open yourself in a self-directed account. And as you're saving and investing, this will help you lower your tax bill and increase your overall returns so that you can achieve your financial goals faster. If you got value from this video, please like, as it'll help the YouTube algorithm, and subscribe if you want more content like this. If your money could talk, it would say, I'm a means and not an end. I'm a tool and a test. I can add meaning to life, but I'm not the meaning of life. Have a great day.